Hey everyone, Marco Palmero, founder of Ulysses in Dubai, and welcome to another episode of Acquisition Case Studies, where we take deals that we have sourced and negotiated in the past, we break them down, we analyze them, we find lessons in mistakes that we have made, so we can then execute better deals in the United Arab Emirates in the Middle East. Of course, as I mentioned all the times, this is our own proprietary deal flow at Ulysses. Most of the cases that we will cover are deals that weren't so good or didn't close for whatever reason, because I think that's where we can find most of the lessons and some of the experiences that we have had here in the Middle East. Of course, these videos are focused on helping all the business leaders, entrepreneurs, and investors interested in buying assets in the United Arab Emirates and in the Middle East. So hopefully our own mistakes, our lessons can help you and provide you some insight so that you can save money, time, and resources in that process. Today, I want to talk with you about a deal that was very interesting. It appeared to be a very good transaction, but it got sticky when we started analyzing the technical aspects of the transaction. And so, as always, I will break down the deal with a brief overview, keeping everything confidential, of course. And I will start by saying that this business was a growing enterprise. It was a company that was opening up a lot of locations across the UAE, and it was also thinking about expanding across the Middle East. So it was a thriving enterprise that was growing fast, and it had only been operational for about 10 years, but it already had 5 locations and growing. They were building 2 more the time we spoke together. Now, the staff in the business was around 100 people, give or take, and there was no real estate involved in the deal. So all the 5 locations were on lease. The reason for the sale was because the guy was a business-minded individual. He was building the business, but he was conscious that a time may come when he needed to sell. And so he was always open to the idea of selling the business. He was preparing the business for a sale continuously, and he welcomed opportunities to sell the business at any point in time. Of course, that was good news, because the moment we heard that from him, we understood that we were talking with somebody who would have a logical approach to the deal and less of an emotional approach, because he was a very business-minded individual. He was focused on building a business, making it profitable, and then sell it and go on to the next thing. So we felt we could have a very productive discussion there, and we decided to get involved in the deal and understand a bit more about the deal dynamics, so to speak. So let's talk about the revenue. We took a look at the revenue of the 5 locations, and the business was generating about $20 million per year in revenue across the 5 locations. So we were talking about give or take 4 million per location. Okay. In terms of EBITDA, I'm going to talk about EBITDA here instead of net profit, since it was a more sizable business. It was generating about 4 million in EBITDA. So around 20% EBITDA margin. Okay. Now, the deal looked fine. Okay. It appears something we could look at, and of course, we decided to start the process of evaluation. We got in contact with their CFO and their financial team, and we started digging into the deal, checking out all the locations and making a lot of visits to these places to understand a bit more about how the business was organized. Now, as we were in the process of due diligence, we realized there was a bit of a problem that the owner didn't mention immediately, over the first couple meetings. And the problem was that some of the key suppliers of these businesses were actually companies that were owned by the same owner. So what that meant was fundamentally that the owner was having a holding company under his own name, and then he was managing 2 different businesses, one of which was the one that we were looking to acquire, generating 20 million and 4 million in EBITDA. The other was more like a B2B business, providing all supplies, machinery, and necessary equipment to this particular entity. Now, you might say, well, that's not a particular issue, right? Well, it actually is, and we will talk about the reasons in a second. Of course, our first thought was, well, if the owner is open to do a deal where he puts everything in one basket, then we'll be open to buy everything, right? By one and two entities, so we can have the full business under our belt. The problem was that the owner was a little bit resistant to that, and that's when the deal kind of started to get sticky. He shared a bit of information about this big B2B business, which I'm sharing to you, with you. That parallel company that was fundamentally providing services only to the parent business was generating about $2.5 million per year with a net profit of about $400K. Now, that sounded okay, and provided the business was well diversified, that wasn't a particular issue. The problem came out when we realized that this B2B business was generating, give or take, 80% of its revenue from providing services in equipment to the business that we were looking to buy. So fundamentally, think about it this way. There is this company that we're looking to buy, generating 20 million in revenue, 4 million in EBITDA. This business is supplying all the equipment and the necessary stuff to operate this company over here. But this company generates 80% of its revenue by working with this business. Now, the problem with that is not really something that happens if you buy the two things together. That's fine. The problem happens if you only buy this, and all of a sudden this business right here decides to increase prices because he's not part of the whole ecosystem anymore. And so it kind of breaks the economies of scale, efficiency that has been created. At that point, the increase in price might force us as acquirer to either change supplier, but it will be very painful, or accept these conditions, thereby reducing our EBITDA and our profitability. As we progress with the analysis, we realize that if the owner were to do something like this, so say, okay, I'm gonna keep the other business, the moment I sell the other, I increase my prices and I squeeze dollars out of these guys, we would basically have an EBITDA that was shaved in half. And that was a very dangerous scenario, and it wasn't really something we were open to accept, because of course the problem in that case would have been that we would have bought the business based on an EBITDA figure that wasn't actually accurate, because it would have been affected by that other business raising prices later and changing the EBITDA dramatically. I hope I explained that correctly. I know it might sound a bit confusing, but that's the point I'm trying to get across to you. The guy might have leveraged this other business to squeeze more money out of us other than a high price for the deal, because it would have had a better price for the deal and ultimately a constant revenue stream generated by us. You might say, okay, Marco, you could have changed supplier, right? Yes, but that is a painful process, especially if you already have somebody who provides everything you do, and it provides it at a very good price. Another point, which is important, is that economies of scale created an EBITDA performance for the main business that was a bit skewed, because yes, you had, how much did I say? 4 million in EBITDA, but you had 4 million in EBITDA because your supplier was providing you everything you needed at a very low price, almost on par to what it cost them to produce. And the margin that the supplier was generating was coming from the 20% of business that was coming from the outside. So the problem there was evident, because this other business was substantially feeding off the other entity, and it was creating a false perception of what that entity was actually worth. The EBITDA should have been adjusted, and that's exactly what we suggested. And of course, it wasn't something the owner was willing to accept. We kind of showed us that there was something cracked over there, and don't get me wrong, we would have accepted the idea of buying the entire thing, because you say, okay, fine, you build a perfect system that works smoothly together. You already have a bit of economies of scale. You have control of the entire value chain. So we're happy to take that over. But the guy wasn't really open to that and made a lot of resistance towards that, which kind of showed us that he was trying to oversell one piece and then squeeze more dollars using the other business. And again, that's not something that we were willing to accept. So the lesson I took out of it was fundamentally to always make sure you check everything that is surrounding the business, not only the business itself, because there might be other aspects that are falling outside of the business operation that are affecting the performance of that company. And in this particular case, it was a supplier that was selling at a huge discount, in allowing this business to have a high EBITDA, which would have been much lower if the supplier would have been another company that was not under a main umbrella of that business. So that was the lesson I took away, broadening the horizons when it comes to due diligence and analysis. And of course, another good point, another lesson that I took away was that economies of scale can help you grow businesses, right? But that's the subject for another video. Now, this is pretty much it for this case study. I hope you enjoyed it, and I'll see you in the next episode.